Welcome to The Tale of Two Profits, Marginal versus Absorption Costing. This video is part of Topic 5 on Strategic Cost Management for Malaysian Decision Makers. We will explore how Puan Aminah discovers that profit is a matter of perspective. Our scene is Batik Fusion SDNBHD in Shah Alam. They produced 10,000 units and sold 8,000 units, leaving 2,000 units in ending inventory. Business is booming, but how do we measure this success? The mystery is that in 1 month, Batik Fusion has two different net profits. The external audit report shows RM 50,000, but the internal operations report shows RM 30,000. The answer to this RM 20,000 difference lies in understanding cost accounting. Our investigation roadmap has 4 subtopics. We will calculate the cost of a product, master the contribution margin tool, construct the different financial statements, and finally, reconcile the gap between the two profits. The costing dilemma involves absorption versus marginal costing, centered around how we treat fixed overheads like rent. Absorption costing is like a sponge, attaching fixed costs to the product for external reporting. Marginal costing is like a clock, expensing fixed costs immediately over time for internal strategy. Subtopic 5.1 covers the ingredients of cost. For Batik Fusion, direct materials are RM 30, direct labor is RM 20, and variable overhead is RM 5. Fixed manufacturing overhead, the factory rent of RM 100,000, is based on 10,000 units. Calculation 1 is the absorption cost, or full cost. Following compliance, we include all direct and variable costs, plus the absorbed fixed overhead of RM 10 per unit. This results in a total product cost of RM 65. Calculation 2 is the marginal cost, or variable cost. For strategy, we exclude fixed overhead, which is treated as a period expense. This leaves us with a total product cost of RM 55. This difference in product cost affects the inventory value. With 2,000 unsold units, absorption valuation is RM 130,000. Marginal valuation is RM 110,000. This RM 20,000 difference is due to the fixed overhead or rent stuck in inventory under absorption costing. Subtopic 5.2 explores the power of the contribution margin, which is the selling price minus all variable costs. This margin is what remains to cover fixed costs and contribute to profit. To calculate the contribution for Batik Fusion, we take the RM 100 selling price and subtract the RM 55 production variable costs and RM 5 sales commission, yielding a RM 40 contribution per shirt. The contribution margin ratio is 40%. Consider a decision scenario. An offer for 1,000 shirts at RM 70 per unit. The absorption lens says no, as the RM 65 cost yields only RM 5 profit. However, the marginal lens says yes, because the RM 70 price is above the RM 55 variable cost, generating a RM 15 contribution. This provides RM 15,000 extra cash to cover fixed costs. Subtopic 5.3 is the financial statements showdown. External reporting uses absorption costing, deducting cost of goods sold to find gross profit. Internal management uses marginal costing, deducting variable costs to find the contribution margin. The absorption income statement reflects the external view, resulting in a net profit of RM 50,000. This method includes a portion of fixed manufacturing overhead in the closing stock. The marginal income statement, used internally, shows a net profit of RM 30,000. Here, the fixed manufacturing overhead of RM 100,000 is expensed in full as a period cost. Subtopic 5.4 is the reconciliation, solving the mystery of the RM 20,000 difference. The money is hiding in the warehouse. In absorption costing, RM 20,000 of factory rent was stored in the 2,000 unsold shirts. The reconciliation statement begins with the marginal costing net profit of RM 30,000. Adding the RM 20,000 fixed overhead in closing stock and subtracting fixed overhead in opening stock brings us to the absorption costing net profit of RM 50,000. The general rules of profit are: if inventory grows, absorption profit is higher. If inventory shrinks, marginal profit is higher. If sales and production are equal, the profits are equal. Absorption costing has the advantage of complying with MFRS/GAAP, but can encourage overproduction. Marginal costing is better for pricing and strategy, but is not allowed for external reporting. The verdict for Batik Fusion is to use absorption costing for external parties like tax, banks, and shareholders. They should use marginal costing internally for pricing, special orders, and break-even analysis. They speak two languages of cost, but tell one story of success. Thank you for watching this video on marginal versus absorption costing.